This video is called The Power of Investing and 10xing the S&P. This is really the why for this series. This is kind of driving home a point of why you should be looking into this stuff and thinking about this stuff. So I'm just going to dig into the technical details here and share my screen. So this is my actual portfolio projection. If you haven't watched my videos in the past couple of years, this is just strictly for a retirement account. There's a lot of different things you can do in the investing world, but to me, this is the low-hanging fruit. It's like everyone should be doing this. But a couple of years ago, I transitioned to a self-directed IRA. So I have a couple other videos if you're not sure what that is. And this is an actual deal that I invested in. This is it was about a $5 million deal. I'm a limited partner. A couple other people came in with me, and we invested in an industrial facility that's housing a business, and it's a percentage. We get a percentage of the revenue share. So let's just say I went in with 100,000. So that's cash out in year zero, right? In the first year, it's projected to be 10% cash on cash. So I get about 10K for my money. In year two, we're expecting to return half of the principal. Okay, so that's what this is. So half of my principal back. I still get a percentage yield, right? But I have less money in that. I have less principal, less equity in that deal. So the cash flow is actually less, but I still get cash flow on my money. In year three, they're expecting to return the rest of the principal. Same thing. I get cash flow on what's remaining. And again, they did the numbers monthly. This is annually. So that's why it doesn't totally make sense of like where this number came from, but this is just high level stuff. And after all the principals returned, what happens is the limited partners get a percentage of the revenue share of the business. So although I have no principal left in that deal, I get a percentage of the revenue share in year 5 and 6. And then at the end of this is the sale of that business, the projected sale. So when you look at this, it's like, okay, it's about 2x over the course of 6 years, right? 2x. That's pretty good, right? But there's a lot of other deals out there that may have similar multiples. But so the point of this that I'm going to drive home is it's not just the multiple. Okay, that's the point of this whole series, is the rate at which you are receiving distributions is the critical thing. Okay, so now I'm going to blow this up to the actual sheet here. Okay, so there are actually 3 deals I'm investing in. So I talked about that business deal. There's also real estate. I'm investing in a mobile home park. It's about 25% IRR. And then I'm investing in a debt validation fund, which is 20% cash flow. Okay, so we can talk about the details of those deals. That's not the point of this. But so I'll talk about what all this is here. But the main thing, right, is rows 1 through 6. So if you decide to do this, what I'm recommending, what you need to understand is you need to be active in reinvesting your distributed capital. Okay. And I'll show you why with these numbers. If you're in an index fund, you never have to do that, right? It compounds. So you don't have to worry about it. You basically invest, and then 25 years later, you start receiving distributions. But that you're going to have a way, way, way lower yield, okay, if you're not receiving distributions than if you're doing something like I'm doing here, and I'm going to show you. But if you're doing something like I'm doing, you have to be reinvesting that capital. So let's talk through this. So the thing I have up here, right, is in my self-directed IRA, I have some cash sitting there, right? That's not in a deal. So right now it's like a couple $1,000. So I keep that in a 5% money market fund. I consider that the risk-free rate. I'm never going to lose that. I'm not worried about ever losing that. Just whatever cash I want it doing something, right? It's not good. And I need it to be liquid, right? So your money market fund is going to be liquid. So that's what you're seeing here. This is the balance. Okay, that's how much cash I have sitting in that money market fund. Now, up here, contribution, that is how much money I'm making. Those are my distributions into that money market fund from my investments. Withdrawals, this is going to be cash that I reinvested. Okay, so every year, like in year 2, I make this much cash flow, say $57,000. I reinvest that. Okay, so I lose 50, so I have about 17K left. So that's how this is working, where it's basically, and I'm doing this annually. This is in actuality would be quarterly, okay, where you're going to be receiving quarterly distributions and you want to reinvest that quarterly. But I didn't feel like having 120 columns on this freaking thing. So that's why I just did it annually. But so what I'm showing here is I'm starting with 100K, right? This analysis right here, I never make another contribution. And I obviously will be, right? But just showing what you can do with 100K if you do something like I'm doing. So year one, right? Nothing too crazy, right? I make 10K, like I said. Year two, I get a pretty big distribution. So guess what I'm going to do? I'm going to put that 50K right into another deal. All right. So that's what this is here. Is I made 57K this year. I put 50K right into deal two. Right now, year three, I'm getting my principal distribution, cash flow distribution from that first deal, and some cash flow from the other deal. Right. So I make 58K plus that 17. At the end of that year, I can do another deal. Right. I'm putting that right into the debt validation fund. So that's how this works, right? So I did that over the course for what my retirement is going to be, which is 25 years. Okay. So in 25 years, if you do something like this, right, that 100K turns into $12 million. All right. 100K turns into $12 million. And you can see here, this IRR, so 25% IRR. So it's like, that's not that high of a number, right? You can find 25% IRR deals. It's just the power of reinvesting, right? These aren't like crazy deals, right? These aren't, some like finding gold type thing. Like these are good. They're upper echelon deals, but they're not crazy. But it's just doing the math of reinvesting, right? Net present value is $2 million, which basically means, this 100,000, which I have, is really worth $2 million if I execute this strategy. And I'll talk about net present value later. So don't worry about it. But it's basically, you want to discount something you're going to get in the future by some percentage called the discount rate. So it's like, the portfolio is 12 million, but that's 25 years from now. So it's worth about 2 million in present day. And I'll talk about that. And the other thing, 125x multiple, right? So I told you this one deal, right, is a 2x multiple, which is reasonable. There's a lot of deals like that. But if you adopt this strategy, that multiple gets much, much, much higher, right, when you reinvest. So now let me go over here to a couple of things I want to cover. 25 years of growth. I kind of talked about this money market fund already. So it's just, you want to keep your cash working for you. And if you do a strategy like this one, you're going to have cash coming in and cash coming out. I talked about the 3 types of deals. So just for simplicity, I just copied these same 3 deals over and over and over. That's not reality, right? I would be investing in different deals, but kind of like I said, 25% IRR is not that rare, right? So these aren't like, unique funds that are only once in a lifetime. These are coming through our pipeline pretty frequently. And again, power of reinvesting. So this is the key takeaway from this video. You want to keep your money working for you. That's why something where you're receiving distributions is so much more powerful than something like an index fund, which is all equity. The other thing is this isn't hard. Like this takes almost no time. You can do this in 15 minutes a year. All right. It's that easy. It takes like 3 emails, right, to set up a self-directed IRA. And then to actually do this, like, we send out an email whenever a deal's coming up. And if you're interested, I'll call you or text you, right? It takes 5-10 minutes to fill out that paperwork. And if you execute this strategy, you're only doing 1 deal a year, right? So like I said, I do it quarterly, but to turn 100K into 12 million is like 15 minutes a year, right? It's not hard. Now, the only caveat I will add there is the hard part is deciding on and getting access to the right operator, right? So that's what I spent 7 years doing, is figuring out the guy that I trust that I'm going to invest in. So now I don't have to spend this extreme amount of time and due diligence on every deal, which I know this guy's doing it and he's way smarter than me, right? He's way better at it than me. So if you decide on your operator, it really, which takes a long time to do. Like I said, 7 years for me. After that, it's like 5-10 minutes a deal, right? Doesn't take a lot of time. And then the last thing, I'll talk about diversification in this video series, but doing something like I'm doing here, where you're investing in things that distribute, that leads to diversity, right? Where, I'm putting $100,000 in one good deal. There's a lot of people out there to be like, oh no, you should put 25 into 4 different deals. It's like, huh? No, this is the best one, right? But guess what? That 100K, because I'm receiving distributions over the course of 25 years, that's going to turn into at least 21 deals, right? If I'm doing one deal a year. Now, when you're over here in like, year 13 and you're making 800K a year in distributions, I'm going to probably do more than one deal, right? But it's like, you don't have to, at the start, put money in all these different things, right? If you invest in the one right thing and you're receiving distributions, that's going to lead to diversification over time. Now, let me do a quick comparison for you for the S&P. I thought this was really interesting. So the most profitable 25-year time period that the S&P ever had was 95 to 2020, 12% year-over-year growth. So that 100K, so same starting amount, would be about 1.3 million. That's good, right? A lot of people are going to be really excited about that. Now, like I said, 10x the S&P. So this predicted strategy is 10xing that, right? And I kind of, like I told you, these are kind of like, these aren't like unique deals. Here's the really interesting though, 95 to 2020, when I think about like who was an adult during that time, right? Who benefited from this? Well, it's all the people that I initially learned investing from, right? It's teachers back in Pittsburgh, it's like the Dave Ramseys, it's baby boomers. So it's like in the period where this was really important for those people, the S&P was doing really well. Well, guess what, guys? If you've seen my other videos, is most big banks and funds are predicting less than half of this for the next decade. It's about 6%. And if you have questions, I can show you those annual reports from Charles Schwab and a bunch of other different funds. 6% is not good. It's not good at all, right? The least profitable time period, 25-year time period, was about 8%. So that 100K turns into 400K. So it's not that like you're going to lose money over the course of 25 years, but compare this to 12 million. And that's, you'll kind of see the power of this other strategy. Let's hit FAQs real quick. So where do you find these, right? As someone kind of asked me a lot. So yeah, guys, I mean, I worked for 7 years to get in this position, right? I did a lot of free work, a lot of networking. And like I said, I found one guy I trust, and now we're partners and we do this. These deals also are not unique at all, but I do have a lot of friends in the institutional investing space. So the difference is, I'm basically directly connecting you to the operator, right? So there's not a lot of overhead. It's an extremely lean process here. Typically what you'll get in like an institutional fund is you have the operator, right? So the same guy, that operator is probably under an umbrella of a larger company. If you're going to invest in institutional, that larger kind of investment firm that's working with these operators are probably working with some sort of like institutional platform, like a CrowdStreet or something like that takes margin. Then on the investor side, maybe like a family office or something like that, they're paying a financial advisor who works through that platform, who works with this umbrella, who then connects you to the operator. So same deal, but you now have 5 layers of arbitration, right? 5 layers of reduced margin, 5 layers of overhead. So that's why when you go to like a CrowdStreet or something like that, the yields are a lot lower than what I'm showing, because you have all that arbitration. And I do just want to note, these opportunities aren't unique, but we are an upper echelon firm, right? So it is like there's high demand for this. Like you do have access. There is high demand. We're typically doing $5 million funds. They're closing in 2 to 3 weeks. So it is high demand. I'm just saying that the actual things we're investing in are not that unique. It's the operational model that is unique. Another question is like, how is this possible? right? Why doesn't Wall Street buy these up, or institutional capital? So there are a couple things to understand. Is these are usually about $5 million funds. That's really low for institutional capital, right? That is not enough to make a dent at all. They'd have to invest in hundreds and hundreds and hundreds of these, so there's not enough supply for those big funds. Because they're so small, there would be extraordinary overhead for all their analysts to be able to underwrite these small deals, right? Because there's layers of approval and all this different stuff. So they want to write big checks, right? They don't want to be writing these small checks. The other thing is, if you're working for like a big family office or institutional capital or something like that, there's governance. Like you have to report to people. There's certain things with accounting that are required. So, so it's hard to merge those kind of like bank-like requirements with a small business like we're working with. And then the main reason is a lot of these operators don't like Wall Street, right? It's kind of it's not that they don't have an opinion. It's like they do not like these types of people, right? They do not like the institutional world. That's why they're doing what they're doing. Bruce Norris told an amazing story about how some guys on Wall Street approached him to kind of manage their money, and he would have made lots and lots of money doing it, but he said no because he didn't want to work for those people. So there's a lot of people like that enjoy working with the everyday person and don't want to work with Wall Street. And then here's the last thing, right? You're looking at these numbers like, this looks like inflated, right? What if one of these deals doesn't go well? So deals can go south, right? Which is why you want to diversify. And like I recommended, diversify over time. But these aren't expected returns. These are conservative, right? It's the general partners are doing these projections. They have skin in this game, right? So they're not going to make up numbers that they don't believe to be true, right? This is based on 20 years of experience in similar deals. And these are conservative estimates. And like I said, it's only a 1 to 2x multiple, right? A lot of these deals can be 3x to 10x. So a lot of these deals can go to the moon. So when that happens, these numbers are going to look a lot bigger than they are right now. The other thing, like I mentioned, this is annually, right? If this was quarterly and you're doing this on a quarterly basis, the returns would be a lot higher than what I'm showing, that 12 million. And then the last thing, like I said, this is a retirement account. In this analysis, I didn't make a contribution for 25 years, right? That's not realistic. So realistically, I would be making contributions and doing more deals. So anyways, guys, it's like, this is, from my perspective, an extremely achievable number in my retirement account with this strategy, turning 100K to 12 million. So I hope that was helpful. And then we've got a couple more videos in the series where this is like the main thing. If you don't understand the math here, that's fine, because I'm gonna break it down in the other ones. And if you have questions, let me know.